69%. That is China's share of global EV battery installations in 2025. CATL alone holds 38% of the entire world market. And yet Japan and Korea are betting billions that a single technology shift, solid-state batteries, could redraw the entire competitive map within 5 years. Welcome to Asia Tech Macro. I'm Alex.
And I'm Maya. Today we're diving into the EV battery supply chain because 3 things happened in the past 6 weeks that make this the right moment. CATL announced its dual-track strategy combining sodium-ion and solid-state development at its December supplier conference. Toyota confirmed BEV production begins in 2026, with solid-state mass production targeted for 2027 to 2028. And China released its first national standard for solid-state battery classification in January 2026, a regulatory signal that Beijing is treating this as strategic infrastructure, not just a technology race.
Let's run the data. Global EV battery installations in 2025 hit 1,228 gigawatt-hours, up 35% year-on-year, according to SNE research. Chinese manufacturers held 69.3% of that market, CATL at 38.1%, BYD at 16.6%, CAL-AB at 4.1%. Korean manufacturers held 19.6% combined, LG Energy Solution at 10.1%, Samsung SDI at 5.4%, SK On at 4.1%. Japan's presence in the installed base is minimal, which is exactly why the solid-state bet matters so much strategically.
And the investment flows reflect that urgency. Toyota confirmed a 1.5 trillion yen, roughly $10 billion, battery investment plan through 2030, with solid-state as the centerpiece. Samsung SDI announced a $3.7 billion solid-state joint venture with Stellantis, targeting 2027 pilot production. And Panasonic, which supplies Tesla, disclosed it as accelerating its own solid-state roadmap with a 2028 commercialization target after receiving additional Japanese government subsidies in January 2026.
Now, here's the number that frames everything. A solid-state battery charges from 10 to 80% in under 10 minutes versus 25 to 45 minutes for current lithium-ion. Energy density is projected at 400 to 500 watt-hours per kilogram, roughly double today's best lithium-ion cells. If those specs hit mass production at competitive cost, it doesn't just improve EVs. It potentially makes range anxiety and charging time, the 2 biggest consumer objections to EV adoption, functionally irrelevant.
Which is exactly why CATL is not sitting still. The company filed over 400 solid-state battery patents in 2025 alone, more than Toyota and Samsung combined, according to a January 2026 patent analysis by Nikkei Asia. CATL's Robin Zhang stated at the December conference that the company targets semi-solid-state battery mass production in 2026 and all solid-state by 2030. China is not conceding the next technology generation. In Part 2, we dig into whether Japan and Korea can actually win this race. Stay with us.
Okay, segment 2. Let's stress test the solid-state bull case, because the technology promise is real, but the gap between laboratory performance and mass production economics is where every previous battery breakthrough has gone to die. Maya, you've been tracking the manufacturing side. What's the actual status?
So here's the honest picture. The chemistry works in the lab. The problem is manufacturing yield at scale. Solid-state batteries require ultra-thin solid electrolyte layers, sometimes as thin as 10 microns, deposited with near-perfect uniformity across large surface areas. Current production yields for prototype cells are running between 60 and 70%, according to industry sources cited by TrendForce in February 2026. For context, lithium-ion production yields at mature facilities run above 95%. That gap translates directly into cost. Solid-state cells currently cost roughly 4 to 6 times more per kilowatt-hour than lithium-ion.
And that cost gap is the central challenge. Toyota's 2027 to 2028 mass production target assumes it can close that gap to roughly 1.5 times the cost of lithium-ion, which would make solid-state viable for premium vehicles first, then cascade down to mass market over 5 years. But Shirley Meng, chief scientist at Argonne National Laboratory, stated in a January 2026 interview with the Financial Times that achieving that cost trajectory requires solving 3 simultaneous manufacturing problems: electrolyte deposition speed, cell stack pressure management, and thermal stability at scale. No company has solved all 3 yet.
Okay, devil's advocate. Toyota has been working on solid-state longer than anyone, since 2008. They hold over 1,300 patents globally, the largest portfolio of any single company. And critically, they've been working with Panasonic through Prime Planet and Energy Solutions, which gives them a direct link to one of the world's most experienced battery manufacturing operations. Isn't there a real first-mover advantage here that the skeptics underweight?
The patent portfolio is real, and I don't dismiss it. But here's the counterpoint. Having the most patents in a technology that isn't yet manufacturable is a bit like having the best map to a destination you can't drive to yet. Samsung SDI's joint venture with Stellantis is arguably more interesting from a commercialization standpoint, because Stellantis' urgency to catch up on EVs means they have every incentive to throw operational resources at making this work, not just resources. When a car company's survival depends on your battery technology working, the collaboration intensity is different.
Which brings us to segment 3, the ripple effect. Because the EV battery race doesn't just affect Toyota and CATL, it has profound implications for Indonesia's nickel strategy, Australia's lithium exports, and the entire critical mineral supply chain we touched on in our China Plus One episode.
The minerals angle is fascinating and underreported. Solid-state batteries use significantly less, or in some designs zero, liquid electrolyte, which reduces the lithium requirement per cell. But they require much larger quantities of specific materials. Lithium metal anodes need high-purity lithium, sulfide-based electrolytes need phosphorus and sulfur, and oxide-based electrolytes need rare earth elements, including lanthanum and zirconium. The critical minerals map for solid-state looks very different from lithium-ion, and that reshuffles who has strategic resource leverage.
Australia wins on lithium either way, but potentially loses on nickel if solid-state adoption reduces battery-grade nickel demand. Indonesia, which we discussed 2 episodes ago, faces a genuine strategic risk. Its entire downstream nickel processing bet is predicated on lithium-ion remaining the dominant chemistry. If solid-state transitions faster than expected, Indonesia's $15 billion nickel processing investment thesis has a serious problem.
And the Korea angle is equally sharp. LG Energy Solution, Samsung SDI, and SK On are all racing to qualify solid-state cells with their existing automotive customers, GM, Ford, BMW, Volkswagen. The risk for Korean manufacturers is a technology transition that happens faster than their capital cycle. They've spent the past 5 years building massive lithium-ion gigafactories in the US and Europe. If solid-state requires fundamentally different manufacturing infrastructure, which the early evidence suggests it does, those gigafactory investments could face premature obsolescence. That's a capital allocation risk that isn't fully reflected in Korean battery stock valuations. In part 3, I want to challenge the entire framing of this race. Don't go anywhere.
All right, contrarian corner, and my view today is this. The entire solid-state battery narrative is being framed as Japan and Korea versus China. I think that's the wrong competitive map entirely. The real threat to CATL's dominance isn't solid-state technology, it's sodium-ion, and the irony is that CATL invented it.
Wait, CATL is its own biggest disruptor?
Exactly. Here's the argument. Sodium-ion batteries use sodium instead of lithium. Sodium is the 6th most abundant element on Earth. It's essentially salt. No cobalt, no nickel, no lithium required. CATL began mass-producing sodium-ion cells in 2025 and is targeting 100 gigawatt-hours of sodium-ion capacity by 2027. The energy density is lower than lithium-ion, currently around 160 watt-hours per kilogram versus 250 to 300 for lithium-ion. But for urban EVs, two-wheelers, and energy storage applications where range is less critical, sodium-ion is already cost-competitive, and the cost trajectory is falling faster than anyone projected 12 months ago.
So the contrarian view is, while everyone is watching the solid-state moonshot race between Toyota and CATL, sodium-ion is quietly eating the bottom of the market right now, and CATL has a 3-year head start.
Precisely. And here's the investment implication that follows from this. The consensus trade is buy Toyota and Korean battery stocks on the solid-state transition thesis, short or underweight CATL because disruption is coming. I think that trade has the timeline completely wrong. Solid-state mass production at competitive cost is a 2028 to 2032 story at the earliest, based on the manufacturing yield data we discussed. Sodium-ion is a 2026 to 2028 story that is already happening. CATL's dual-track strategy, sodium-ion for volume, solid-state for premium, means they potentially dominate both the current generation and the transition periods simultaneously. That's not a company about to be disrupted. That's a company managing a technology portfolio more sophisticated than any of its competitors.
But doesn't sodium-ion actually help Japan and Korea indirectly? If sodium-ion commoditizes the low end of the market, it pushes the whole industry toward higher performance applications, where solid-state has its strongest advantages: long-range EVs, aviation, grid storage. That plays to Toyota and Samsung SDI's premium positioning.
That's a fair point, and it's the sophisticated bull case for the Japan-Korea solid-state thesis. But the timing mismatch is still the problem. Toyota needs its automotive customers to wait for solid-state while paying premium prices for current lithium-ion vehicles against Chinese competitors who are already offering sodium-ion-equipped EVs at mass-market price points. BYD launched its first sodium-ion-equipped model in January 2026 at a price point that undercuts every comparable Japanese and Korean EV by 15 to 20%. That's not a future threat. That's a current market share problem.
Okay, and here's the question I want our listeners to sit with. The EV battery race is often framed as a technology competition, but what I keep coming back to is that it's actually a capital allocation competition. Toyota has 1,300 solid-state patents and a 1.5 trillion yen investment plan. CATL has 400 new solid-state patents filed in a single year, plus a functioning sodium-ion mass production line, plus 38% global market share, generating the cash flow to fund all of it simultaneously. So the question is, in a race where the finish line keeps moving, does it matter more who has the best technology or who has the most resources to stay in the race the longest? Because those two questions lead to very different investment conclusions.
That is exactly the right frame. Part 4 has our answer. Stay with us. All right, action items. 3 concrete things to do with everything we discussed today.
Number 1, separate your battery investment thesis by time horizon before you do anything else. If your horizon is 2026 to 2028, the sodium-ion story is already playing out and CATL is the dominant position. The stock trades at approximately 18 times forward earnings, a significant discount to its 5-year average of 28 times, partly because Western investors are pricing in disruption risk that the sodium-ion dual-track strategy actively mitigates. If your horizon is 2029 to 2033, the solid-state transition becomes investable, and Toyota, Samsung SDI, and Panasonic become the relevant names. The mistake is conflating those two timeframes into a single trade. They require different position sizing, different catalysts, and different exit triggers. Number 2, watch Indonesia's nickel processing sector as a leading indicator for lithium-ion demand durability. We flagged this in our China Plus One episode. Indonesia's entire downstream processing bed assumes lithium-ion remains dominant through at least 2030. If sodium-ion adoption accelerates faster than the current consensus timeline, which is a real possibility given BYD's January 2026 launch pricing, battery-grade nickel demand growth slows materially before Indonesia's processing capacity is fully utilized. That's a significant downside scenario for the Indonesian nickel investment thesis and for the Japanese and Korean trading companies that have taken equity stakes in those projects. Track BYD and CATL sodium-ion shipment data quarterly as your early warning signal. Number 3, pay attention to the Japanese government's solid-state subsidy calendar for the first half of 2026. Tokyo has been quietly expanding its battery technology support beyond the initial netto grants. Panasonic's January 2026 acceleration announcement was directly tied to a new subsidy tranche. If the government announces a major expansion of solid-state manufacturing support in Q2 2026, it de-risks Toyota and Panasonic's commercialization timeline meaningfully. This is an underwatched policy catalyst that could move Japanese battery-related stocks significantly without being on most investors' radars.
The takeaway for today: the EV battery race in Asia is more complex than the headline narrative suggests. China's dominance via CATL is real and reinforced, not weakened, by the sodium-ion transition that is already happening. Japan's solid-state bet is technically credible, but faces a manufacturing yield and cost challenge that pushes mass commercialization toward the end of this decade. Korea's gigafactory investments face a potential capital cycle mismatch if the technology transition accelerates. The investors who navigate this correctly will be the ones who resist the temptation to pick a single winner, and instead map their exposure carefully across the technology timeline.
And the meta lesson: in deep technology transitions, the incumbent with the best cash flow usually survives long enough to participate in the new paradigm. Disruption timelines are almost always longer than the disruptors predict.
Next time on Asia Tech Macro, we're looking at the rise of Asia's sovereign wealth funds as technology investors. GIC, Temasek, KDIC, and the Abu Dhabi funds are quietly becoming some of the most influential capital allocators in the global AI and semiconductor landscape. Who are they backing? What is their strategy? And what does it signal about where smart long-term money is going in Asian tech? That's next.
That one is going to be eye-opening. The numbers are larger than most people realize.
Stay data-driven. Bye.